What's up, guys? I hope you're doing well. So I found a kind of, I guess, a recent speech done by, I believe she is the Federal Reserve President of the Cleveland Reserve Bank. Her last name is Mester, I think. Basically going over what she deems, what she calls, as she even explicitly stated in the speech, the Great Recalibration for monetary policy. So is it kind of like going back to historical norms or what? Anyways, we'll see. So we'll hop right over to the screen share of the transcript. Go over here. Make sure it's big enough for you guys. Okay. So yeah, and she gave this speech in what was it? A little the International Research Forum on Monetary Policy, and this was all sponsored by the says Euro Area Business Cycle Network, the ECB, and the Federal Reserve Board. Basically, just started out with making notes of March 2020, where when we had, I guess, the pandemic crash or whatever you want to call it. And the FOMC reduced the target range Fed funds for all the way down to 0 and 25, between 0 and 25 basis points, right? They took Fed funds all the way to the zero bound. They also basically, since they were already at the zero bound, had to use QE, or the balance sheet, as a policy tool, and started buying large quantities of treasuries and agency mortgage-backed securities, which is like the Freddie Mae and Freddie Mac, the mortgage, or the MBSs, the mortgage-backed sausages, as some people call them. And they did this, as she says, to reduce the severe strains in financial markets seen early, and to support the economy. And basically, looking forward, they're indicating that basically ongoing rate increases and basically eventually reducing the balance sheets starting in June. So next month. Yeah, next month. So I highlighted this part in green. I have called the Great Recalibration of U.S. monetary policy a shift from the extraordinarily accommodative policy, basically down to quote unquote normal, I guess. I don't think it's really deemed as normal or where they're going to start from there. But anyways, and she even says so that it didn't really even happen when they actually started taking, I guess, liftoff for the Fed funds rate. She says that it began in autumn of last year. So last September, when the FOMC indicated that it would soon be time to taper asset purchases, and it announced the beginning of tapering in November. And then in December, the FOMC sped up the tapering, basically also indicating earlier liftoff of the policy rate, so Fed funds. And then in January, the FOMC indicated that it would soon be time to raise the policy rate, and then followed through with the first increase in March. And then asset purchases also ended in early March, right? So when they actually officially stopped quantitative easing, so to speak, they stopped purchasing. I don't know if it'd be I think technically they stopped increasing the size of their balance sheet. I mean, because you have to think about it, these are treasuries on their balance sheet. So when they mature, they can just let them roll off. And basically, I think they're just purchasing enough, or were just purchasing enough to basically be equivalent to the amount rolling off, keeping the balance sheet level. So basically, her reasoning. So the U.S. economic growth was very strong last year, with real GDP growing at 5.5%, the highest annual pace since 1984. Ironic, and well above the trend growth rate, which I estimate to be around 2%. The decline in real GDP in the first quarter was driven mainly by declines in net export, government spending, and still high but lower level of inventory investment compared to fourth quarter of last year. Growth in consumer spending and business fixed investment remained solid last quarter, and there continues to be positive underlying momentum in demand, which I don't remember if it's explicitly stated in here, but I think the whole point that she states later is they're going to dampen demand. At least that's the whole point, because the whole argument for the inflation is that it's the imbalance between supply and demand, and then all like the supply chains and how many of the upward forces or whatever on inflation are supply driven. Later, I'll wait to comment on that until further into the speech, just to make sure I'm not just talking about a different source that I read. So labor markets are tight. The unemployment rate has fallen to 3.6%, nearly as low as the lowest reading during the pre-pandemic expansion. Labor force participation remains below its pre-pandemic level, but it has improved significantly over time. Still, labor supply has been unable to keep up with the robust demand for labor. And I think she also puts something about like there's two job openings for every unemployed worker, and they're just not going to work for whatever reasons those may be. Excuse me. But yeah, and so with demand balance with supply, here we get into what I was talking about earlier. With both products and labor markets, prices and wages have moved up. Price pressures have broadened across goods and services, and inflation readings in the U.S. are now at their highest levels in 40 years. And so I think one of the things that they were talking about, so in terms of the broadening across goods and services for inflation, to where they're really broadening into, say, more like what they call sticky numbers, because you have to remember, like a lot of the times, one of the nuances I've noticed is like people, like average Joes, Janes, whatever, really focus on the CPI, whereas that's not really what the Fed is focused on per se. They prefer more of the personal consumption expenditures, I think, index, the PCE, whatever it stands for. It's based off of consumption rather than consumer prices, which which are related, but they're not the same thing. And so with the demand out of just one of the things that I was kind of wanting to talk a little bit about a few minutes ago, with the supply and with supply and demand being out of balance, and as she says, product and labor markets, and then also saying that wherever it was, I already lost it. Basically, continues that to continue to expect like positive underlying momentum in demand, and she'll even say later that they can't. The Federal Reserve can't print oil. They can't print wheat. They can't. They have to. Basically, all they can influence is demand in that respect. And so, if there's a supply-demand imbalance and there's not enough supply to meet demand, and the Fed has to do something about it, then the only thing they can do is decrease demand. I mean, I guess technically that you could argue that they could monetize even more debt to invest in ventures that increase the supply. But again, when you're talking about, especially with commodities and stuff, that's not a short term. You can't just flip a switch and you have an oil refinery sort of thing, or it's working better or whatever. There's a lot that goes into that. I don't know. I'm going to refrain from that so that I don't go down too deep of a rabbit hole, because I'll just continue talking and completely ignore, completely get lost in whatever the speech was supposed to be about. But anyways, so back on topic, the employment cost index for private industry workers accelerated over the last 3 months, ending in March, rising at a 5.8% annual pace. Higher wages that reflect higher productivity growth are a positive for the economy, and a higher level of wages represents a shift of income share from capital to labor. but the current pace of wage increases is inconsistent with maintaining price stability, right? So what does that kind of mean? So basically, she says it's positive that people are getting paid higher wages, and this whole shift from income, so the corporate income or whatever, from they're no longer spending it on like capital, like actually like growing the business and stuff, so to speak, but they're paying their workers more. And so you kind of, I guess, where this they're saying it's too, she says it's too high, so the current pace of wage increases is inconsistent with maintaining price stability. That leads me to believe, when you hear, especially with price stability, you're thinking like inflation, right? So stable prices are not high inflation. Um, and so basically the wage increases are, you're having a kind of wage, what is it, a wage price spiral, I think is what they call it, to where basically people are getting paid more, and so they have more disposable income, and then they spend it, which bids up prices, which means people have to get paid more to buy necessities, and then they do get paid more, and then it just kind of spirals and keeps going and so on. Which I believe was kind of the case in the 1970s, if I'm not mistaken, at least for part of it. Not entirely sure on that. I haven't studied that period very much in depth. So maybe, but that concept is still the same. So continuing on, from a risk management perspective, argues for such caution because inflation risks are to the upside, and because the longer inflation runs above our goal, the higher risk that long-term inflation expectations will become unanchored, thereby making the return to price stability much more costly. And so basically the problem is, I mean, if you have purely more of a like low levels of consumer price inflation, apparently, as they define, is stable prices, say 2%, as they say, is their goal, and they're kind of defining that as stable prices. So apparently, um, but I mean, you're also dealing with this kind of society in general, right? And so you have people when like when they're going to the grocery store to buy food and gas and stuff that they need to live, and the prices just keep going up. There's a change in psychology there at a certain point, and that's where these kind of long-term inflation expectations come in. And she says, the whole unanchored part of it, right? And so if they become unanchored, then basically, people are like, the prices are just going to always go up. And so that's a change in psychology in the person, to where it's not like, oh, I can just buy chicken every week at Walmart or whatever. And the price, okay, it's going up a little bit, but I can still buy chicken. And all of a sudden, it keeps going. You realize over a long period of time, like, hey, every time I go to the store to buy chicken, just as an example, obviously, the price is higher. So you start to buy chicken, like all of it, as much as you can. And so you just kind of like start stocking up on chicken. And then so it kind of just accelerates the pace of the inflation, right? And that's the whole, like, it becomes unanchored. And it's really that change in psychology of, I guess, the populace that really changes things, to where it's no longer such, to where it would be much harder to control or bring down, I guess. I don't know. And this is where, I guess, when she's saying making the return to price stability much more costly, is they'd have to be a lot more drastic, um, in order to bring that price stability back, or at least what they call price stability, which is 2% CPI inflation. Um, Never mind that, but yeah. Um, Okay, so the current target range for Fed funds is 75 to 100 basis points, and says this is well below the range of estimates for longer term neutral nominal policy rate. So Fed funds, which neither stimulates or restrains the economy. And that's kind of how a neutral interest rate in terms of Fed funds is. You can think of it as, when we know, or as we're told, I guess, or it's generally believed that, lowering interest rates is accommodative, and so people can borrow more at lower interest rates and so on. So they're incentivized to spend more or whatever, and um, it's kind of an easing of monetary conditions, so to speak. And then it's the opposite when rates increase too much, right? And so this kind of neutral nominal policy rate, so neutral Fed funds, is kind of an interest rate to where they're thinking it will no longer like stimulate the economy or restrain the economy, make it harder and stuff for things to grow or whatever. So it's kind of it's neutral. It's rather self-explanatory. I just kind of wanted to elaborate a little bit because it's not something I've really explained or had. It hasn't come up in any of the previous videos. So I just thought I'd take a few seconds to say that real quick. But anyways, and so basically, they say the real Fed funds rate is still negative. Yeah, just a bit. And so, given economic conditions, ongoing increases in the Fed funds rate are called for. And unless there are some big surprises, it's expected to be appropriate to raise the policy rate another 50 basis point at each of our next two meetings. And so that would basically put the policy rate at 1.75 and 2%. And so inflation and unless interest rates come down unless inflation comes down further, I mean, you still have negative real Fed funds, right? But it's interesting because you still have to deal with the psychology of it, of the people. Kind of the same. It's the same argument for unanchored inflation expectations, I guess. When you're dealing with consumer price inflation, I mean, that's more consumer driven, which means you have to do a lot more with the psychology of the people, right? And so it's the same argument I said a few minutes ago. So you might not, it might not be necessary to have positive real rates in order to dampen consumer price inflation specifically. Maybe not necessarily, as long as people think it's going to lower it down, then they'll act accordingly. Which is really kind of going back on the reasons for the wage price spiral. I don't know. It's something that I've been thinking about a little bit, and I'm not 100%. Obviously, as you can probably tell, I'm still working through it. But it's definitely like an interesting proposal, I guess, and worth mentioning. Anyways, back to the speech. So at that point, the nominal Fed funds rate will be nearing the lower end of estimates of the neutral rate. So apparently that neutral rate's about 2% or somewhere in the twos. And then the balance sheet reductions will be underway. So basically QT, quantitative tightening. And the FOMC will then be well positioned to consider the appropriate pace at which to continue removing accommodation over the balance sheet of the year. Over the balance of the year and how far above neutral rates will need to go. It will be challenging to remove accommodation at the pace needed to get inflation under control while sustaining healthy labor market conditions. Again, maybe I'm not quite sure of where she's going at it, because it almost seems like they're trying to do this. It'll be challenging to remove accommodation, so reducing the size of the Fed's balance sheet while increasing Fed funds at the pace needed to get inflation under control, right? To get control of the CPI and PCE, while sustaining healthy labor market conditions. But she also talked about previously in the same speech on how the labor market's extremely tight. And so maybe I'm not 100% sure on what you define as a healthy labor market. Especially with the labor force participation rate. Yeah, she stated that it increased significantly, but it's still. Anyways, maybe it's something along the same lines as, price stability is 2% CPI. So I don't know. So broader financial conditions have already tightened considerably as markets have anticipated further rate increases in light of the Fed's forward guidance, talking them off the ledge. And so, like mortgage rates, basically in last September they were under 3%, and now they're above 5. And so, I mean, I did a video on this specifically back in January or February, where I was looking at a kind of a longer um, term chart of mortgage rates, and we could see where they bottomed out in the very beginning of 2021, I believe. No, end of 2021, early 2022. And then you could see that one little blip up to where that we had that one print or whatever where they started to go up a little bit. And then I was like, it'd be interesting to see what happens with those, if it just kind of blips and stays stagnant, or if it just takes off. And so it took off. um but yeah. um and so one of the things I've noticed with these is, if you really want to get into the nuances and really understand kind of what's going on, you really have to deal with, how they're defining everything. I'm about to say right now. So, in addition to raising their policy rate when initiating the balance sheet reduction in June, it'll be done primarily by adjusting the reinvestment amounts of the principal payments the Fed receives on its assets. So the interest they get paid for holding those treasuries or the other MBSs. So they'll allow up to 30 billion per month in treasuries and 17.5 billion in agency securities to run off the balance sheet. And then after 3 months, these caps will be raised to 60 and 35 respectively, right? And so basically it doesn't seem like they're actually planning on selling the securities. They're actually just letting them run off the balance sheet, right? So letting them mature and just not replacing them with new ones. And so the plan that the FOMC announced last week did not rule out asset sales. So there's that. And they'd favor the FOMC considering asset sales after the balance sheet reduction is well underway to speed up the return of the portfolio's composition to primarily treasury securities. So it seems like even that they pretty much just want to roll off the agency MBSs and other securities they have, not just the treasuries, at least to some extent. And then she gets a little bit into the ample reserve regime, which this topic specifically, I've written one post about it, and I'll probably link it in the description below, just to give it to you guys so you can get to it easy, because it really goes into also an interesting proposal on kind of the difference between what this actually means, right, and how they're defining it. And that the fact that she even says here the ample level of reserves is uncertain. They don't know. Basically, it's as low as it can get without breaking something. And we saw this with the repo spike in 2019. So yeah. Anyways, and then I think I also made another kind of a bit of a, no, I don't know if it'd be a revelation really. There is something weird happened with base money with M naught and at the same time period, but it's skipping my mind right now. Yeah. Anyways, we'll leave it at that. I don't want to waste your guys' time. So, anyways, that's all I got for this one. I'll link possibly two of those, both the ample reserves regime posts and the M not one, just in case. And those two, you can also find the actual video I did for those as well inside the post if you so wish. But anyways, especially with these ones, to where like I'm kind of thinking through a lot of them. I mean, comments and feedbacks are fully welcome. Basically, really trying to figure this stuff out and think about it from different angles and such. But anyways, I'll leave you guys with that one, and I hope you guys have a good night.